In 2008, Warren Buffett was declared the richest person in the world. As the CEO of Berkshire Hathaway, he commands a business empire that includes insurance companies, media companies, manufacturing, clothing, and even makers of candy and sodas. Yet Buffett has as much a reputation as a teacher as he does as a business tycoon. The Essays of Warren Buffett is compiled by editor Lawrence A. Cunningham from Buffett's annual reports to Berkshire Hathaway shareholders. Buffett views his company's shareholders as his fellow owners and business partners, and he uses his annual report as a platform to educate them on Berkshire's inner workings, the logic behind his investment decisions, and the fundamental principles and philosophies he applies as his guide to building their wealth. Therefore, Buffett's essays provide a window into the mind of the world's most successful investor, a man whose ideas and values are in stark contrast with the stereotypical Wall Street business mogul. His insights on investing are easy to conceptualize but difficult to put into practice, and his thoughts on the culture of the wider business world shine a light on the ethics, or the lack thereof, that shape the modern financial landscape. Warren Buffett and Berkshire Hathaway. In Buffett's official biography, The Snowball, Alice Schroeder explains how he developed his outlook on business and his philosophy of investing. Buffett's early obsession with numbers, combined with a childhood during the Great Depression, led him to see the collection of wealth as a path to personal independence. Eschewing the fast-paced Wall Street lifestyle, Buffett began his investment business in his hometown of Omaha, Nebraska, where he still lives in the house he bought for his family in 1958. Buffett's company Berkshire Hathaway began life as two separate Massachusetts textile businesses that merged in 1955. Buffett bought Berkshire Hathaway as an investment for his partners in 1965, and by 1985, he'd completely converted it into a holding company, a business that exists to buy and control shares in other businesses. Berkshire Hathaway is now one of the largest holding companies in the world, controlling over $700 billion in capital, while its original identity as a struggling textile firm is long past. In this guide, we'll cover Buffett's writings on investment practices in general and what goes on behind the scenes in the world of high finance. On investing, we'll examine Buffett's recommended practices. On investing, we'll examine Buffett's recommended practices, which ideas he considers to be faulty in the realm of economics, and specific types of investments to avoid. In the investment business section, we'll contrast his views on the typical Wall Street firm with the culture and principles of Berkshire Hathaway. In addition to illustrating Buffett's ideas, we'll look at the writings of other financial experts, both those in agreement with Buffett's way of thinking and those who present an alternate view. We'll place Buffett's career and essays in their appropriate historical context, and we'll look at how well his ideas hold up in the modern world of investment. New section: How to Invest. For casual and professional investors alike, the most salient insights from Buffett's essays are his thoughts about the do's and don'ts of the stock market. The key philosophy that Buffett drives home is that owning a stock means owning a piece of an actual, real-world business. Using this owner mindset as a starting point, Buffett provides guidance to reasonable expectations, best practices in investing, common economic modes of thought that Buffett believes are utter nonsense, and certain pitfalls to avoid when investing. In summary, Buffett recommends you identify and invest in a solid, well-run business at a time when that business's stock is offered at a discount to its overall value. Buffett's strategy is conceptually simple, though it entails a lot of work for investors to learn how to properly value businesses in order to know if the price is high or low. Once you buy into a good business, Buffett recommends holding onto its stock indefinitely, so long as the business remains well managed and provides a steady return on capital. Because the value of a stock is directly linked to the fortunes of the business itself, in the long run, stocks can't provide higher returns on investment than the businesses they represent can turn capital into profit. Short-form note: in the classic text A Random Walk Down Wall Street, economist Burton G. Malkiel gives a more detailed description of how to calculate a stock's long-term returns, which are based on a combination of dividends, the portion of a company's profits paid directly to shareholders, and the company's projected growth in earnings over time. Malkiel says that short-term investors must also factor in the ratio of a stock's share price to the company's earnings, which varies dramatically from year to year. Like Buffett, Malkiel suggests that to generate overall positive returns, it's best to hold on to stocks for a long time. This goes against Wall Street's common narrative, in which stock prices and businesses' value have little to do with each other. In general, the market trends upward over time, but Buffett is clear that the market is driven by investors' collective emotional mood swings. Those swings sometimes offer great buys at good prices, but otherwise, you should ignore the random moods of the market. Some short-term traders may use swings in the market to make a quick buck, but most of them will fail. Meanwhile, trading itself causes a financial drain in the form of fees to investment banks and brokers. Buffett endorses long-term financial commitments in which you can make the most of your dollar. Short-form note. Short-term traders bet on their ability to accurately forecast the future. In super forecasting, journalist Dan Gardner and psychologist Philip Tetlock argue that there are people who can do this, but they're rare. Good forecasters know how to avoid cognitive bias, consider more than one perspective, and think in terms of future probabilities. All of these are traits that could easily describe Buffett, but he studiously avoids making forecasts of the future. In The Snowball, Buffett's biographer Alice Schroeder says the one prediction Buffett did make was that tech stocks in the 90s would prove a poor investment. He was right. Best practices. Though Buffett's essays mainly explain how he makes investment decisions on behalf of Berkshire Hathaway shareholders, he shares a great deal of advice that applies to individual investors as well. Principal among these are that you should invest in industries you understand, recognize the value of market volatility, and put your money in simple index funds to benefit from the market's general upward momentum. Buffett drives home the business ownership aspect of buying stock and suggests that you use any industry knowledge you have to your advantage. For example, if your work overlaps with the publishing industry, then you know which companies are the industry leaders and which have the best future prospects. If the top 2 or 3 are publicly traded and their stock doesn't seem overpriced, put a significant amount of money into those businesses. Short-form note. A publicly traded company is one whose stock is for sale on open stock exchanges and not held by a handful of private investors. You are now an owner of a piece of business that you understand well. If the company's stock shoots up after you buy it, don't consider that a signal to sell. Rather, look forward to your long-term gains as an owner, rather than the short-term gains you may receive from trading. Short-form note. Acting on general knowledge about an industry or public information about a company is distinct from illegal insider trading, in which someone misuses non-public information to profit from a trade in a public company's stock. Because people very close to the workings of a business, such as its CEO and directors, always have access to non-public information, the U.S. Securities and Exchange Commission, SEC, has strict rules about reporting any trades executives make of their own company's stock, rules that are continually amended to close loopholes. Buffett says that in the short run, stock prices aren't a good measure of a business's true value. Instead, what matters is whether a company makes effective use of capital to produce good returns in the form of steady profits. For this reason, avoid industries in which you lack knowledge and where future prospects are hard to predict. Buffett favors companies whose products can weather any market downturn, items that people will always need to buy regardless of economic ups and downs, such as food, clothing, insurance, and utilities. Short-form note. Buffett practices what author Jim Collins calls hedgehog thinking. According to Collins in his book Good to Great, hedgehog thinkers are those who don't spread their expertise thin, but instead focus on the one thing they do best and with the most passion. For Buffett, that passion is analyzing businesses to determine their true value. For those who aren't financial experts, that focus might be the industry you work in or a trend you follow closely. In Poor Charlie's Almanac, Buffett's business partner Charles Munger defines this as your circle of competence, which determines the areas within which you can make good decisions. The upside of volatility. While downturns and volatility can be frightening, Buffett echoes his teacher Benjamin Graham, who said that for investors, volatility is good. Because the market's behavior is irrational, it occasionally offers fantastic deals. And while rising stock prices may be pleasing to owners, if you're an investor buying into a company, you want stock prices to be low. High stock prices are only beneficial to people intending to sell. As long as a company's stock price remains low, you can get higher returns on your money by buying ever larger portions of the business. Short form note: market volatility is defined as the amount and frequency at which a stock price fluctuates. The volatility index, VIX, for example, is a tool used to measure the volatility of the 500 largest U.S. public companies, commonly known as the S&P 500. A VIX rating of 20 or higher signals a time of high market volatility, while a rating of 12 or below indicates low volatility in trading. While modern investment portfolios are designed to hedge against volatility as a way to handle risk, for investors like Graham and Buffett, market volatility is a tool to be exploited. If you don't have the time or resources to do thorough research into business valuation, he recommends putting your money into a simple, unmanaged S&P index fund. That way, your gains will match the overall market with minimal loss to brokerage trading fees. Forget the excitement that comes from day trading and watching individual stocks go up and down. Remember that every trade loses money to fees, and that trying to beat the market in your gains is tantamount to gambling at a casino. Mindful investing. In The Intelligent Investor, Buffett's mentor Benjamin Graham differentiates between thoughtful investors and speculators, who are led by emotion and irrational optimism. Graham says most people are defensive investors who wish to make money simply and safely without putting too much effort into decisions. If this describes you, then low-cost index funds are ideal. Aggressive but thoughtful investors, such as Buffett, put all their time and energy into well-researched investments, in effect making investing a full-time profession. In I Will Teach You to Be Rich, Ramit Sethi lays out the steps for slow and deliberate personal investing. He advises starting with retirement accounts, such as your employer's 401k if available, then opening your own Roth IRA. Sethi then says to automate your payments into your investment accounts and to explore index and mutual funds before educating yourself on other types of equities. Economic nonsense. While much of Buffett's writing seems like common sense, his ideas go against the grain of many financial professionals. Buffett himself points out where his views and those of other investors disagree. 3 specific points of contention are efficient market theory, diversified portfolios, and the supposed value of financial advisors. Efficient market theory. Efficient market theory, EMT, is based on the premise that financial markets are inherently rational and all-knowing. Proponents of EMT believe that stock prices always reflect the actual value of their companies, making any deeper analysis irrelevant. Stock price fluctuations are sufficient to determine a company's overall health. Buffett disagrees strongly, and he points to his history and those of his associates, who have made their fortunes by assuming instead that researching a company reveals its true worth, and that stock fluctuations are largely meaningless, except for the opportunities they provide. He feels that EMT has been sufficiently discredited, so he finds it annoying that it's still taught in business schools. Short form note. In a random walk down Wall Street, Malkiel defends efficient market theory while claiming that it's a misstatement to say that EMT's predictions of stock prices are always correct. Malkiel suggests that stock market crashes validate efficient market theory because they represent natural price corrections. However, EMT's underlying implication that investors are rational actors was dealt a blow in 1975 by psychologists Daniel Kahneman and Amos Tversky. In The Undoing Project, Michael Lewis describes how the two psychologists overturned contemporary economic theory by proving that humans are fundamentally irrational, throwing a wrench into much of the economic research of their day. Diversification. Another financial sacred cow that Buffett scorns is the idea that diversifying your portfolio protects against risk. He argues that this concept originates from academic models that equate risk with volatility and use diversification as a means to minimize the total volatility in your investments. As in EMT, this theory takes nothing into account except stock price. If a good company's stock were to suddenly drop, this mode of thinking would label it risky and tell you not to buy it. Buffett defines risk as the odds of suffering financial harm and says the best way to avoid it is to put most of your money on a few safe bets. Companies with good management and excellent long-term economics, no matter their short-term stock fluctuations. Short-form note. Portfolio diversification is a strategy of investing in a wide assortment of assets, with the assumption that even if some go down in value, the ones that go up will offset your losses. In I Will Teach You to Be Rich, SETI offers a general template for diversifying your portfolio. Investing in index and mutual funds brings with it automatic diversification, because those funds' value depends on the performance of a multitude of assets. The problem with diversification is that while it offers the psychological value of reducing risk, it reduces your overall return on investment because weak assets undercut the value of those that do well. A glance at Berkshire Hathaway's diversified holdings may make it look like Buffett doesn't take his own advice. However, several factors must be noted. 1. As a holding company, Berkshire has far too much money to invest in only one place. 2. Most of its investments are in the form of majority shares in the businesses it owns. When Berkshire buys into a company, it commits a significant amount of capital, instead of merely buying a few stocks as a hedge against market volatility. 3. Though Berkshire's investments are widely diversified, Buffett's personal holdings are not. Nearly all of Buffett's wealth is in the form of Berkshire Hathaway stock. Short-form note. Buffett's all-or-nothing approach to investing is echoed by mathematician Nassim Nicholas Taleb in his book Skin in the Game, in which he presents an ethical argument for concentrated investing as opposed to diversification. Taleb claims that those who get rich by risking their wealth in creative endeavors, such as building a prosperous business, also enrich society as a whole, while those who minimize their risk as wealth increases aren't motivated to add value back to the world. They simply ride on the coattails of others. Financial advisors. Most of all, Buffett derides the culture of brokers and advisors who create and sell complicated financial instruments, encourage people to make trades often, and obfuscate any market clarity to convince investors that their services are needed. It's said that the person who gets richest from a gold rush is the one selling the shovels. Likewise, the chief result of the efforts of brokers, advisors, and money managers is the transfer of wealth away from investors into the hands of investment professionals, skimmed off the top in the form of service fees. And while financial advisors and money managers claim they'll be able to outperform the overall market, the vast majority of them will fail. Short-form note. In finance, if the sum of your investments produces a higher return than that of a baseline like the Dow or S&P 500, you can say that you've beaten the market. While this is the professed goal of money managers, it's one that they rarely, if ever, achieve. In I Will Teach You to Be Rich, SETI points out that when financial experts do beat the market, it's more because of luck than skill. SETI suggests that money managers' poor track record is hidden behind a cloud of survivorship bias. Buffett is very much the exception to the rule. Since transitioning Berkshire Hathaway from a textile business to a holding company, Buffett's portfolio has outstripped the S&P 500 by 3,000%. These professionals feed off both fear and optimism in the market in order to enrich themselves. The system incentivizes brokers and advisors to recommend more trades and more financial products, even in times when investors would be wiser to let their money sit in an index fund with minimal fees. What's worse, advisors bear none of the risk as their clients' fortunes rise or fall. Independent financial planners. If you're uncomfortable investing without professional assistance, one option is to hire an independent certified financial planner. Instead of being incentivized to sell one institution's financial products and to encourage frequent trading, independent planners create a tailored financial plan that the client is able to follow or disregard. Many independent planners make no direct transactions on behalf of their clients, and therefore don't incur the steady stream of fees that Buffett disdains. Independent planners' earnings are not tied directly to the success of their clients, but neither do they suffer from the conflicts of interest of advisors whose first priority is meeting their firm's target investment goals. A list of independent financial planners in the U.S. can be found at the National Association of Personal Financial Advisors website. What to avoid. From his discussion of his choices, Buffett clearly prefers equities, stocks and bonds, over other forms of investment. Nevertheless, he spends time explaining several other forms of investment and the reasons that they're problematic. He discusses unproductive assets, junk bonds, financial derivatives, and the worst sin of all, using debt to finance acquisitions. Some bad investments are made out of fear. People want to keep their money safe in case of a financial crisis. Money market funds and bonds appear safe, but Buffett points out that their interest doesn't keep pace with inflation. Money in those investments loses value, even as the total dollar figure slowly rises. Short-form note: money market funds are not the same as money market accounts, a type of savings account. A money market fund is a mutual fund that invests in short-term, low-risk financial instruments. Bonds, on the other hand, are fixed-interest loans made by you, the investor, to a company or the government. The most famous of these may be the U.S. war bonds used to finance the United States' participation in the Second World War. More foolish, though, is to invest in assets that are completely unproductive, such as jewelry, collectibles, or gold. Unlike a business, these investments create nothing. These items only have value at all as long as people believe that they do. People who invest in unproductive assets hope that someone else will pay a higher price for them in the future, a hope based more in fantasy than fact. Short-form note: the most popular current types of unproductive assets are gold and other precious metals. But the classic example of unproductive investment speculation is the Dutch tulip craze of 1636, when for a short while, tulips became a hot investment commodity in the Netherlands before prices fell back to rational levels. Fantasy also drives the market for junk bonds. These are bonds issued by companies that are already saddled with more debt than they can bear. Junk bonds are a way to refinance that debt, but the issuing companies are in such poor financial straits that they still pose a very high risk of default. Nevertheless, there are investment firms that funnel lots of money into the junk bond market, believing once again that diversification minimizes risk. In the case of junk bonds, this is much the same as buying a lot of lottery tickets in order to increase your chance of winning. Buffett writes that junk bonds exacerbate financial crises on a regular basis. Short-form note: junk bonds are often marketed more enticingly as high-yield bonds because of their promised high rate of return. The market for junk bonds was particularly active in the 1980s, until a series of defaults in 1989 sent the stock market into a downturn that led to the bankruptcy of the investment firm Drexel Burnham, one of the chief underwriters of junk bonds. There were fears of a similar crisis in 2015, but the junk bond market stabilized itself. Despite the risk involved with high-yield bonds, in a random walk down Wall Street, Burton G. Malkiel doesn't discount them as an option for young investors with diversified portfolios. Financial derivatives. The most troublesome of all complex financial products are derivatives, such as those that drove the subprime mortgage crisis. Buffett explains that derivatives are contracts between two parties in which one pays the other if some other financial instrument, for example a stock or a bond, reaches a certain price, up or down. In the simplest terms, derivatives are bets that a portion of the market will behave a certain way. They are instruments of pure speculation, and unless there's some form of collateral involved, a derivative's value rests entirely on the financial strength of the parties involved in the gamble. Short-form note: the specific types of derivatives that precipitated the 2008 financial crisis were credit default swaps based on subprime mortgages. In a credit default swap, Bank A exchanges a variable rate loan for a fixed rate loan held by Bank B. Bank A hopes to protect itself from the possibility of rising interest rates, while Bank B is betting that interest rates will stay low. By 2008, the number of credit default swaps had grown exponentially, making them extremely vulnerable to a sudden decline in the real estate market. Buffett argues that derivatives are also instruments of fraud. Until the derivative actually comes due, both parties to the bet can use fictitious projections to claim that their derivatives produce actual earnings, and then get paid by their investors based on those supposed earnings, like receiving a cut from a racehorse's winnings before the race is even run. It's only when one of the parties tries to cash in on their derivative contract that any fictitious claims about its value are revealed. And if the loser of the derivative bet defaults, then both sides' projected earnings disappear. Before that time comes, however, derivative contracts are designed to be so complex that their true risks and false earnings claims are hard for portfolio auditors to spot. Short-form note. A striking case of derivatives fraud was perpetrated in 1995 by Nick Leeson, a derivatives trader for the United Kingdom's Barings Bank. Leeson gambled a vast amount of money using derivatives to bet on Japan's Nikkei 225 stock index, then manipulated accounting records to hide the scope of his losses, which led to Barings Bank going bankrupt. However, most cases of derivatives fraud rise from dealers misrepresenting the amount of risk to investors, as with mortgage derivatives in 2008 or currency derivatives in 2009. It's been proposed that creating a market manipulation index would give regulators a tool to zero in on markets being targeted by derivatives fraud. Even more than avoiding such toxic financial products, Buffett wants to impress upon his readers that you should never borrow money to invest. This has always been the curse of Wall Street, and it's led many individuals, companies, and banks straight down the road to financial ruin. Brokers, advisors, and money managers sugarcoat debt by calling it leverage, which fueled the corporate takeover craze of the 1980s. Easy access to debt can be like a drug, especially when tied to the thrill of investing. Eventually, though, all debts come due, and if your investments have dropped in value, you won't be able to pay your debts off. However, if you only invest with cash, you'll be well prepared for any hiccups in the market. Short-form note. Financial experts agree with Buffett that being debt-free is of paramount importance to your financial health. In Rich Dad's Cash Flow Quadrant, Robert Kiyosaki says getting out of debt first is a prerequisite for smart investing, especially if your debt is tied up in high-interest credit cards that drain your financial resources faster than returns on investment can replace them. However, if your debt carries a low interest rate, it might be wise to start investing anyway. In I Will Teach You to Be Rich, Sethi identifies student loans as one such low-interest form of debt. Because he emphasizes the importance of starting to invest at a young age, he says that you should do so even if your student loans aren't fully paid off. New section: How to Run an Investment Business. Though much of Buffett's writing contains lessons for any investor, a great deal of his work is devoted to the inner workings of Berkshire Hathaway as it compares to other large investment groups. Buffett believes that the Berkshire system stands above others in terms of transparency, rational investing, and creating value for its shareholders. In this section, we'll contrast Buffett's depiction of the less-than-ideal practices he sees as the norm in corporate America with Berkshire Hathaway's values and culture. For each, we'll look at issues of corporate governance, accountability, acquisitions principles, and commitment to shareholder interests. The Wall Street Way. In discussing the proper management of investment firms, Buffett puts forth many negative examples as lessons to learn from. Wall Street's business-as-usual practices highlight many areas in which most investment companies don't serve the interests of the people whose money they steward. Buffett describes the failings of CEO culture, shady accounting, overpriced acquisitions, and the systemic dangers of financial derivatives. The chief problem Buffett sees with many CEOs is their lack of any true accountability. In theory, CEOs must answer to a board of directors, but in practice, that relationship is overly chummy. Directors themselves have little accountability, don't pay attention to their company's business practices, and rarely put themselves on the line to call out poor management. As a result, many CEOs are rewarded for simple mediocrity. Boards and CEOs often do nothing but ride on the wave of their underlings' efforts, inflate earnings reports by holding back money from investors, then safely escape with their golden parachutes if the company fails or is bought out. Short-form note. In theory, a company's CEO and board of directors are answerable to the shareholders, who have the power to vote the board out of office. However, this rarely happens without instigation from the top. In Basic Economics, Thomas Sowell points out that for the most part, shareholders want to reap the benefits of investing without going through the hassle of managing a business. Many board elections are uncontested. Directors must simply receive more votes for than against them in order to retain their positions. However, there's been a trend in recent years of shareholders taking a more active interest in who sits on corporate boards and how they steer their companies in regard to social and environmental issues. Buffett's ire is particularly strong in regard to awarding stock options as a form of CEO compensation. Managers often negotiate for these because once awarded, the stock options value isn't tied in any way to CEO performance. A CEO could do nothing for 10 years, cash in his options, and receive as much pay as if he'd been effectively running his company. Businesses, in turn, like to award stock options as pay because certain accounting rules let them not be recorded as an expense. However, Buffett argues their expense is very real. Short form note: a stock option is a contractual agreement that allows someone the option to buy or sell a stock at a predetermined price at a future date. When that date arrives, the stock option price and the stock's actual price may be wildly divergent. For example, if you hold a stock option to buy Company A stock at $100 per share and the actual stock price shoots up to $200, you can call in your option, buy the stock at the lower $100 price, and immediately double the value of your holdings. However, if the stock price drops instead, you don't have to buy it at all. You've lost nothing. Some employee stock options plans require you to vest over time, but many CEOs are awarded stock options as a form of free money bonus when they are hired. The theory behind stock options is that they align the CEO with the shareholders. If the CEO adds value to the company, his stock options will be worth more over time. However, an investor must pay the going market price for his stock, whereas the CEO often receives a locked-in rate with the option not to make the purchase. The CEO with stock options, therefore, can reap the same rewards as shareholders but carries none of the risk. Buffett lobbied for a change in accounting rules that would force businesses to list stock options as an expense, but he lost. The trouble with stock options. A different argument against stock options than the one Buffett makes is that stock options incentivize CEOs to make risky decisions on behalf of their company in order to make the stock's value spike above its true value. Risky behavior could just as likely make the stock price plummet, in which case shareholders lose value, but the CEO loses nothing. Many corporations still award stock options as a way to boost CEO compensation, despite the fact that there's no correlation between CEO pay and a company's prosperity. A 2021 study by Harvard Business Review showed that stock options are only effective in situations where CEOs might otherwise misuse company resources for personal gain. A recent study of CEO pay shows that over 70% comes from stock awards and options, 20% from bonuses, and less than 10% from their actual salary. Takeovers, debt, and danger. Though Buffett has made a career of buying interests in companies he admires, many corporate firms do the same in ways that are foolhardy at best and actively harm shareholders at worst. A lot of buyouts and takeovers are driven by CEOs and acquisitions managers who see corporate growth as an end in itself, regardless of whether it adds meaningful value. When one business pays too high a price for another, it will sometimes have to issue stock as a way to fund the purchase. Issuing new stock provides an influx of cash without taking on debt, but it reduces the value of the stock already in shareholders' hands. They now own a smaller slice of the pie, while management gets to reward itself for expanding the reach of its corporate domain. Short form note: when raising quick capital is in a company's interest, but you don't want to impact the value of shares in the way that Buffett describes above, a case can be made for issuing bonds instead of new stock. Bonds are a form of debt that must eventually be repaid to investors, but the interest rates on bonds are generally lower than the interest companies pay when borrowing money from a bank, and bonds come with fewer strings attached than bank loans. Investors should be wary, however, of bonds issued by companies that are in financial trouble. These are the junk bonds mentioned earlier in this guide. The relentless drive for corporate growth has also given birth to the leveraged buyout, in which Company A takes on debt in order to buy Company B. The buyers then carve up Company B, sell off parts to other businesses, and generate earnings by laying off employees. Buffett explains that takeover companies bend accounting rules to make their acquisitions seem profitable while deferring payment on their debt as long as possible. Buffett asks what the cost to society will be to have so many companies saddled with debt. Many people's livelihoods depend on the health of large corporations, and corporate debt puts all of them at risk. Short-form note. Leveraged buyouts were the hallmark of many notorious corporate raiders in the 1980s, who used them to practice so-called hostile takeovers. Businessman Carl Icahn is remembered for his hostile takeover of the airline TWA, from which he made nearly $500 million while saddling the airline with a staggering amount of debt. Another famous corporate raider, Ron Perlman, is best known for his takeover of Revlon. The negative public image of the hostile takeover magnate was solidified by Michael Douglas's portrayal of the fictional Gordon Gekko in the 1987 movie Wall Street. While leveraged buyouts harm the health of whole companies, the bankers who facilitate them ride into the sunset with the earnings from their fees. Here Buffett returns to the topic of derivatives. The firms that take part in costly acquisitions use derivatives to hedge against the risk their debt incurs. Buffett argues that derivative contracts can act as insurance on smaller scales, but pose a danger to the larger economy. A vast web of derivatives should minimize risk by spreading it around, but in practice, the bulk of the risk has gravitated toward a handful of giant interlinked firms. Any serious shock to the system that triggers a wave of derivative defaults could bring these firms and the whole economy crumbling down like an avalanche. The financial and social cost of leveraged buyouts. A counterintuitive aspect of leveraged buyouts that Buffett doesn't fully explain is that they transfer the burden of debt onto the company being bought, not the company making the acquisition. For example, when Company A takes out a loan to purchase Company B, it uses Company B's assets as collateral, so that if the loan defaults, Company B goes bankrupt, but not Company A. This is why Elon Musk's purchase of Twitter saddled Twitter with $13 billion in debt. However, unlike other buyouts that avoid putting the acquiring party at risk, Musk put $33 billion of his own money into the purchase. Therefore, because Twitter wasn't able to shoulder its new debt, its drop in value resulted in Musk setting the Guinness World Record for greatest loss of personal net worth in history. The potential consequences of the Twitter debacle shine a light on Buffett's point about the societal impact of corporate insolvency. In this case, it's because Twitter has a wider scope of impact than other social media outlets in fields such as politics and journalism. In addition to costing over 4,000 people their jobs, the platform's potential collapse could alter the information landscape in ways we can't predict, affecting how its users share information and build brands, all for the sake of a leveraged buyout. The Berkshire Way. As a positive counterexample to standard Wall Street business practices, Buffett holds up his own holding company, Berkshire Hathaway. He takes the time to explain the reasoning and philosophies behind everything he does as Berkshire's CEO, so that his shareholders can fully understand the company that they all own. Buffett spells out Berkshire Hathaway's goals, his approach to management accountability, his process for folding new companies into the Berkshire conglomerate, and his company's prospects, not predictions, for the future. To begin with, Berkshire Hathaway's long-term goal is to increase its overall value per share, not the size of its holdings. It does this by owning and acquiring companies in good financial standing that produce respectable returns on capital investment. Buffett also wants the company's shareholders to fully understand Berkshire's financial position and the value added by its subsidiary companies, what Buffett refers to as look-through earnings. To do this, Berkshire goes beyond standard financial reporting practices to give shareholders the same information any owner would want about their business's financial and managerial standing. Short-form note. The generally accepted accounting principles, GAAP, that Buffett frequently takes issue with are established by the Financial Accounting Standards Board, a nonprofit organization recognized by the U.S. Securities and Exchange Commission as being the arbiters of what constitutes fair and transparent financial reporting. The FASB has been criticized for not responding quickly enough to changing accounting practices and the creation of increasingly complex financial instruments. Nevertheless, the FASB releases updates to GAAP throughout the year, sometimes on a near monthly basis. Even though Berkshire's stock price is already very high, Buffett doesn't necessarily want it to shoot up even higher. Instead, he wants the stock price to reflect the company's true value as closely as it can. This, he says, will attract investors who share Berkshire Hathaway's values and culture of rational investing and long-term commitment. Berkshire isn't a place for day traders, and it doesn't pay out dividends to investors. Instead, it uses its massive earnings to allocate capital where it can have the most impact on the corporation's overall worth. Short-form note. Though Buffett's essays were written over a period of decades, they remain consistent in reflecting that he'd rather Berkshire stock be fairly priced than overvalued. Nevertheless, Berkshire Hathaway's Class A stock is by far the most expensive in the world, trading at almost $500,000 per share, 5 times the amount of its closest stock price rival, the Swiss candy company Lindt & Sprüngli. Berkshire's Class B shares, which represent smaller ownership and voting rights, are more within the reach of the everyday investor. Berkshire's Class A stock price grew so high that it caused computer problems for the Nasdaq's online stock exchange. Buffett says he views his investors as partners, and it's important that he, as CEO, be open and accountable for his decisions. Therefore, he reports to a board of directors who are all required to be owners as well. In order to hold a place on Berkshire's board, each director must own at least $4 million in Berkshire stock that was purchased outright, not through options or grants. That way, the director's earnings rise or fall along with all other shareholders, and they won't make decisions that benefit themselves at other shareholders' expense. Short-form note. Buffett's partnership mindset toward investors has roots far deeper than Berkshire Hathaway. As Alice Schroeder recounts in Buffett's biography, The Snowball, Buffett's first business venture after leaving Wall Street was the formation of Buffett Associates Limited in 1956, an investment partnership between himself, friends, and family. Buffett would invest his partner's seed money and take his own share from a percentage of their earnings. In order to ethically share his partner's risk, the terms of the business would penalize Buffett if the value of the partnership's investments went down. He dissolved Buffett Associates in 1969 when he felt he'd no longer be able to match the returns he'd provided his partners in the previous decade. As for the managers of Berkshire's subsidiaries, Buffett awards bonuses based on performance, which he makes clear are not dependent on Berkshire's stock price going up. Instead, CEO compensation is judged on the nature of their businesses, the challenges they face, and the real returns they generate. Berkshire's managers are, of course, welcome to buy the company's stock at market price, just like everyone else. If they do, then unlike CEOs with stock options, their interests will truly be aligned with the owners. Short-form note. In Built to Last, Jim Collins and Jerry Porras go beyond issues of CEO pay to debunk the basic premise that a charismatic, high-powered CEO is beneficial to a company's standing. Instead, good management focuses on building the organization and its products, rather than increasing managers' own personal wealth and recognition. More than merely being aligned with shareholders, Collins and Porras suggest that a good CEO will be aligned with the company's core philosophies and principles, which reach beyond shareholder interests to increase the benefit the company provides to the world. Growing the Berkshire family of businesses. Buffett happily admits that acquiring new businesses is his favorite part of his job. While in his youth he looked for mid-range businesses available for cheap, with Berkshire he seeks out high-quality companies that he can buy for fair prices. Such good deals are rare today, so he doesn't set any acquisition targets. Instead, for every opportunity that arises, he compares the potential value of an acquisition to other more conservative ways to invest. This removes the pressure for growth that drives many CEOs to rush into acquisitions based on arbitrary goals. Short-form note. A 2018 study identified several irrational factors that drive corporate acquisitions. Among these are greed, a desire for more power, antagonism between competing companies, and the hubris that companies making acquisitions feel when they believe they can perform better than others. The authors of the study recommend that companies involved in corporate acquisitions examine their motives from an emotional perspective to avoid any unintended consequences that may result from irrational decision-making. Though Buffett views each acquisition with a critical eye, once Berkshire buys a controlling share, Buffett lets his new acquisitions conduct their business with minimal interference. It's not Berkshire's policy to buy up smaller companies only to tear them apart and sell them off. Instead, Buffett portrays himself as the ideal buyer for companies whose owners want the businesses they built to carry on without them. For this reason, Berkshire never sells off an acquisition so long as it can produce even a modest return on investment, recognizing that a mid-tier business is still a vital source of income for its employees and their families. Short-form note. In The Snowball, Schroeder gives several examples of businesses that Buffett absorbed into the Berkshire conglomerate while keeping their essential character intact. One that exemplifies Buffett's preferred type of acquisitions was Omaha's landmark Nebraska Furniture Mart, founded by Rose Blumkin, a Russian immigrant who was 40 years Buffett's senior and whom he looked up to greatly. When Blumkin decided to sell, Buffett arranged to keep her family on as partners so that the store would continue to run as it always had, with Buffett merely providing the capital it needed in order to keep turning a profit. In keeping with Buffett's philosophy of investing, Berkshire never leverages debt to buy new businesses. Instead, it maintains a ready supply of cash from its various subsidiaries to be used for acquisitions. In times when there aren't any businesses to buy, that cash can be used to buy back shares of Berkshire stock. This is only done if Berkshire stock is trading below the company's actual value, and Buffett explains how such buybacks serve the interests of Berkshire shareholders. After all, if Buffett reduces the number of slices in the Berkshire pie, the shares that remain increase in value without their owners having spent a dime. Short-form note. One other benefit of stock buybacks is that they can result in larger dividend payouts for those who remain as shareholders. Buffett doesn't bring this up because unlike most profitable companies, Berkshire doesn't pay dividends at all, instead choosing to reinvest all of its profits to increase share value in other ways. However, some CEOs use buybacks as a tool to push stock prices up. While this may result in higher earnings per share, those earnings are an artificial product of accounting and don't reflect actual growth in a company's productivity, and may in fact be harmful in the long run, because buybacks spend capital that might otherwise be used to invest in more productive assets for the corporation. That owner-centric mindset is at the heart of Berkshire Hathaway's culture, one which Buffett says he's carefully cultivated so that it will last even after he's gone. While describing what makes Berkshire work, he admits that its model would be difficult to replicate. His wealth and Berkshire's grew over decades in which much changed in the financial world. Though he doubts it's possible for Berkshire's gains in the next 50 years to match its first half-century, he has full confidence in the business he created to thrive and endure in the decades to come. Short-form note. Because the practices and rules of high finance have changed so much in Buffett's lifetime, it's impossible to copy his road to riches exactly. However, Buffett encourages the wealthy to copy him in other ways, especially when it comes to philanthropy. In 2010, Buffett joined with Bill and Melinda Gates to challenge the richest people in the world to leave the majority of their wealth to charity. From 40 original signatories, the giving pledge has now been taken by over 200 billionaires.